Here's something most people get completely wrong about their Roth conversions. They think the hard part is deciding whether to convert, but the real mistake is how they pay the taxes on that conversion. I watch retirees convert hundreds of thousands of dollars, pay the tax bill the normal way, and wind up leaving $30,000, $50,000, even $100,000 on the table without even realizing it. IRA millionaires, they never pay the way you think. And once you understand how they do it differently, you'll see why it matters so much to your retirement income plan. I'm Mark Wisniewski, president of Southern Incomes. I work with retirees who want to optimize their tax strategy so they can keep more of what they've built. And today, I'm breaking down 3 ways wealthy retirees pay their Roth conversion taxes that most people never even consider. If this is helpful, hit subscribe and like this video. And if you want personalized help building a retirement tax plan that actually works for you, book a time with me. Links in the description. Part 1, the mistake most people make. Here's what most people do. They convert $100,000 from their IRA to a Roth. Then they write a check from their savings account to cover that $25,000 tax bill. Sounds logical, right? You move money, you pay the tax, and you're done. But here's the problem, and this is critical. They're using after-tax money to pay a tax on a conversion, and they're often doing it in a year when their income is already high. That means they're paying at the top marginal tax rate, maybe 24%, 32%, even 37%. And if you're in a state with income tax, you could be looking at 40% or more going straight to taxes. Now, think about what this really means. You just converted $100,000, but you paid $25,000 or maybe even $40,000 in taxes for money that was already taxed when you earned it. That's like a double hit. It's like getting financially punched twice by the IRS, and it's completely avoidable if you know what you're doing. Wealthy retirees, they think differently. They don't just react to the tax bill, they design around it. Part 2, strategy 1, pay from non-retirement assets strategically. The first thing IRA millionaires do is they pay conversion tax from taxable brokerage accounts, not a checking account or savings account. And there's a very specific reason for this. When you pay from a brokerage account, you have options. Maybe you've got positions with capital losses that you've been sitting on. You can harvest those losses and use them to offset other gains. Maybe say you've got appreciated stock that you were planning to sell anyway. Now you're killing 2 birds with 1 stone. You're being intentional about which dollars leave your portfolio and when they leave. Let me give you a real example. I had a client a few years ago who wanted to convert $200,000 from his IRA. He was going to withhold right around $60,000 for taxes. I told him, stop. Do not do that. We paid the $60,000 from his brokerage account instead. And that extra $60,000 he kept in the Roth, yeah, it's now worth over $90,000 and it's growing completely tax-free. The goal is to move as much money into the Roth as possible without shrinking that amount that winds up getting there. That's how you maximize your long-term benefit. Part 3, strategy 2. Time it during income valleys. Here's a second thing wealthy retirees do differently, timing. And this is where I'd say most people wind up leaving the most money on the table. Millionaires don't convert in their highest earning years. They wait for what I would call income valley, years when their taxable income is artificially low. And if you plan your retirement right, you can actually create these valleys. Here's what I mean. Let's say you retired at 62, you're not taking Social Security yet because you're waiting until 70 to maximize your benefit. Your pension hasn't kicked in, and of course, you're not taking RMDs yet because you're not 73. Your taxable income might be only $40,000, maybe $50,000 a year if you're living off of savings or Roth withdrawals. That's your window. That's when you convert. Because now a $100,000 conversion might only cost you 12% or 22% in federal taxes instead of 32 or 37%. That difference is huge. Congress might fight for years over 3% or 5% tax cut. You just gave yourself a 10% tax cut. Let me walk you through a real scenario. I had a couple who retired at 62 with right about $1.8 million in their IRAs. If they waited until they were 73 and RMDs started, their taxable income would have been around $150,000 a year. Conversions on that income level would have pushed them well into the 32% bracket, maybe even the 35% bracket. Instead, we did partial conversions every year from age 63 to 72. Their income during those years was about $60,000 because they were living off of their brokerage account. And we converted anywhere between $80,000 to $100,000 per year, and most of it stayed in that 12% and 22% bracket. Over 10 years, we moved nearly $900,000 into Roth accounts, and they saved at least $80,000 in taxes compared to waiting. That's what income valleys can do. But you have to plan for them. They don't just happen. Part 4, strategy 3, layer in deductions and do partial conversions. The third strategy is what I call layering. This is, well, it's where the real sophistication comes in. Wealthy retirees don't just convert and hope for the best. They're layering in other strategies to keep their effective tax rate as low as possible. Maybe they're timing a large charitable contribution in the same year as a conversion to offset the income, or maybe they're bunching deductions, say paying 2 years of property taxes in 1 year, for example, so they can itemize and reduce their taxable income. If they own a business, well, maybe they might be offsetting that conversion income with a business loss or even a big equipment purchase. If they've got rental properties, maybe they're accelerating depreciation. The point is, they're not looking at conversion in isolation. They're looking at their entire tax picture and asking the question, how do we make this as efficient as possible? Instead of guessing, they use tax brackets to decide exactly how much to convert every single year. Let me show you how this works. Let's say you're married and your taxable income this year is $60,000. The top 12% bracket for married couples is around $94,000. That means you've got $34,000 of room left in that bracket. So you convert $34,000. That's it. You pay 12% on that conversion and you're done for the year. Next year, you do it again. And the year after that. And over 10 years, you might move $300,000, maybe $400,000 into a Roth. And guess what? You never once hit that 24% bracket, let alone even higher. Compare that to someone who tries to convert, say, $400,000 all at once. They're paying 24%, 32%, and maybe even 37% on a huge chunk of all that money. The tax bill could be $120,000 or even more. But if you spread it out and stay in those lower brackets, you might only pay $50,000 or $60,000 total. That's a $60,000 to $70,000 savings just from being patient and strategic. This is how you move $2 million in an IRA into a Roth without ever hitting those high brackets. It takes discipline, but the payoff is enormous. Part 5, why this matters long term. Here's the bottom line, and I really want you to hear this. How you pay tax on Roth conversions can be just as important as whether you do the conversions at all. It's the truth. If you pay from the wrong account at the wrong time in the wrong tax bracket, you're leaving tens of thousands, maybe even hundreds of thousands of dollars on the table, and you'll never get that money back. Think about it this way. Let's say you save even $50,000 in taxes over 10 years by doing those conversions strategically instead of just randomly. That $50,000 invested and growing tax-free in a Roth for, say, 20 years Could easily be $150,000 or even more. That's real money. That's legacy money. That's the difference between running out of money at 85 and leaving a tax-free inheritance for your kids. And here's what most people don't realize. Once the money is in the Roth, it grows tax-free forever. No RMDs, no taxes on withdrawals, no surprises. If you do this right, you can create a tax-free income stream in retirement that gives you so much more flexibility. This isn't about outsmarting the IRS or hiding the money in the Cayman Islands or even finding loopholes. It is about being strategic with the rules that already exist. The tax code allows for Roth conversions. It allows for income planning. It rewards people who think ahead. But you have to know what you're doing, and of course you have to have a plan. If you want help building a retirement tax plan that's optimized for your situation, not just some generic advice that you happen to find on the internet, book a call with me. I'll walk you through your Roth conversion strategy, your income plan, your RMD strategy, and how to keep more of what you've saved so that you can actually enjoy retirement. The link's in the description. Let's build a plan that works. Thanks for watching, and I'll see you in the next one.